Hello there everyone, today's video is all about property tax. Now specifically claiming tax relief on pre-letting expenditure. So assuming you are a landlord and you've got a property that's new, not necessarily a brand new property, but new to your portfolio. So you've gone out and got this property and you need a few quid spending on it to do it up. What are the tax implications? So what we need to do is break down the categories of expenditure. We're going to have a look at three of them, particularly furnishings and equipment, structural improvements, and repairs and decorations. So the first one, furnishings and equipment. So this is a wide-ranging area of expenditure that covers all sorts of things from white goods, utensils, carpets, curtains, all that kind of stuff, which if you're buying it for the first time, could be quite significant, and you'd hope that you can get tax relief. But what does the law say? Well, the law says that if you're a landlord buying this stuff for the very first time on the property, you cannot get the tax relief against your income tax or corporation tax if it's in a company. The first spend, not tax deductible. However, when you come to replace these items, when you come to replace the carpets and the curtains and the white goods, then at that point you get the tax relief. So what do if you want to improve the situation? Well, here's what you do. You enter into an agreement with the vendor, the property that you've just purchased, and you say, look, instead of giving you £200,000 for the property, I'll give you 199 grand plus £1,000 for all of this stuff. So you get the items listed in the sales particular that when you buy the property. So in effect, you've already paid for it. That is the first expenditure. Not on the new stuff that you've thought in your head you're going to have to kit this place out with. You buy it with all the stuff there. You think, well, hang on a minute. I don't know, it's pretty crappy gear. We don't want to hang on to this. But listen, stay with me. So you buy the property, list all the stuff that you're also buying, the furniture, the equipment, okay? And then look at the timeline on this. So you buy the property with all the furnishings and equipment in, then you spend however many months or weeks doing it up, doing all the other stuff that we're going to come and talk about, then you put it on the market to let. And it's at that point, when it goes on the market, that's when you buy the replacement items. Because at that point, that is a replacement. You already own them on that property because they were part of the sales particulars when you bought the property. So that then counts as a replacement. If you're spending 5-10 grand, whatever it is on a furniture pack, that is a replacement and you get the tax relief. So crucially, it is the second acquisition, not the first, because when you bought the property, those items were part of the deal. And that qualifies for the tax relief, which you'd obviously probably choose to do because I'm assuming a lot of this stuff that you bought off the vendor, like I said, is pretty rubbish gear, and you need to, in order to get tenants in, you've got to buy all this stuff. But hey, listen, that's how you do it, to get a tax deduction. Right, next category, structural improvements. You've got your property that's just new to your portfolio and it's you do a few things to it, say some internal walls need knocking down or loft conversion. Well, what's the tax treatment of that? Well, that is not tax deductible in that year. So it's not what we call a revenue tax deductible expenditure. HMRC say, look, structural stuff like this, you cannot get immediate tax relief. However, it does reduce any future capital gain. So what you would normally do is put this stuff together with the cost of the building on your balance sheets, whether you're a sole trader, landlord, or a company, and it's you made a note of it. It's there, you can see it, and then at the back end, as I say, when you sell, which could be many years, but at least at that point there will be tax relief. So it will reduce your capital gain, will the amount that you've spent on these structural improvements. third section, repairs and redecoration. So just generally sprucing the place up, for want of a better phrase, getting the decorators in, fixing a few things. Could be fixing quite a lot of things. Now, interestingly on this, they are repairs, they are redecorating, they are renewals. HMRC may, in the old days, they used to have this mindset that if the house was in such a state of disrepair that you had to do so much stuff before anyone would even get into the property that they would deny tax relief on this. But that is no longer the case, because if it's generally repair, redecoration, renew, the 3 R's, even if the house is in a bit of a mess and you wouldn't want anyone coming in, you get the tax relief. You'll get the tax relief. So don't let them say, look, you spent so much on this, it was obviously not in a state of letting in the first place. Well, no, you say absolutely it was. It was just the fact that, in my opinion, it was pretty run down and we needed to spend a lot. It was still, livable. We just chose to do a few structural things to get another bedroom in or whatever. But stand your ground on this one here, repairs and redecoration. And, like I said, the 3 R's, you show those and you should be fine. So just an overview there on the different types of expenditure that landlords will incur before they let out a property, pre-letting expenditure. And I've done separate videos on the sorts of things that you can claim against your tax bill after you start letting, which encompasses way more stuff than this. Obviously, things like your professional fees, your letting fees, your mileage claims, but that's on a separate video. So just an overview there on pre-letting expenditure and the tax reliefs thereon. If you like this video, please do subscribe, and I'll see you soon.